EPAM Systems is a company that helps other businesses create and improve their software and digital products. And just recently they announced that EPAM will acquire First Derivative, a service and consulting business for the capital market industry. So they are expanding all the time. They are chasing new opportunities and entering new markets. In 2021, EPAM was added to the S&P 500 and included among the list of Forbes Global 2000 companies. EPAM has also been featured multiple times on Forbes' list of the 25 fastest growing public tech companies. However, growth is only a part of the story. Let's analyze and value this company, and I am pretty confident that you will find other very interesting reasons to consider EPAM as an investment. If you were to invest $1,000 into this company 10 years ago, you could buy 23 shares. And now they would be worth around $4,508. And that is a gain of 350% in 10 years. That is very nice. But as we know, future does not have to look anything like the past. So let's analyze EPAM to better understand it. Individual insiders, that is a check. 3.2% of the company is owned by individual insiders. And Arkady Dobkin, the co-founder and CEO, owns over 3%, so the management has its skin in the game. And are individual insiders buying? That is an X. We saw some sale transactions around a year ago, but nothing major. And the super investors own this company. That is a check. We see 2 super investors that put their money into this company. And are they buying right now? That is an X. Super investors bought over 175,000 shares recently and sold almost 940,000 shares. And this result is mainly due to Stephen Mandel, who just closed his position in EPAM Systems. Return on invested capital, that is a check at 15.8% 10-year median returns. And we want to see this number higher than 10%, so a nice return. And what do we know about net profit margin? It is a check averaging 10.8% over 5 years. And the industry median is 4.6%. So that shows the strong position EPAM has in the industry. And now let's take a look at share buyback. It is an X. They issued 20.2% extra shares in the last 10 years. So unfortunately, they are diluting long-term investors. But it is worth pointing out that since 2021, the number of shares almost didn't change. So they are on the right path. And the debt, it is a check. They have almost no debt. So now the issuing of shares makes sense. They prefer to get funding by issuing shares rather than taking on debt and paying interest on it. That may be a wise way of finding capital for growth. So let's take a look at it. Revenue growth, that is a check at 23.8% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so that is very impressive. Free cash flow growth, that is also a check at 28.9% in the last 10 years, so another great result. And earnings per share growth, that is a check at 18.6% in the last 10 years. So it is lower than free cash flow or revenue because they were issuing extra shares during the last 10 years. That is why we don't like to see our shares diluted by such practices. EPAM does not pay any dividends right now, and they actually never did. They always use their cash to grow the business and make acquisitions. Price to earnings ratio is 27.8, so that is a lot. EPAM may be expensive right now. But considering how fast it is growing, such PE may also be justified. So let's try to predict its future growth and use a discounted cash flow analysis to value EPAM. In the low scenario, we'll estimate a growth of 5% for the first 5 years and then 4%. In the medium, 10% and then 8%. And in the high scenario, 18% and then 15% growth. So the low scenario is close to the predicted growth of the industry, which is around 4.4%. Medium is showing a story in which EPAM is growing twice as fast as the industry. And the high one is predicting that the growth will be very similar to what we saw in the last 10 years. So with such estimates, the intrinsic value in the low scenario is $175, in the medium $231, and in the high scenario $378. But we have to apply a margin of safety to those prices. I always use a 30% one. And with such a margin, we get in the low scenario $122, in the medium $162, and in the high one $265. And the current price is around $193. So it seems that currently EPAM is close to its fair value. So we have here a company that has nice financial health, very nice growth, and is fairly valued, or at least not far from it. On the other hand, it is diluting investors by issuing shares. But to get a better perspective, let's compare it to some other companies we analyzed on this channel. For that, let's go to our Stock Ranking Pro, which you can get access to by becoming a patron. And here we see that if we sort all of the companies by the difference between the intrinsic value and the price, EPAM shows as 32nd cheapest company out of 98 that are currently in the ranking. But if we filter it to show only IT services and software, EPAM is the second cheapest stock from that category. And if we look at the overview of the company, we see that investor sentiment and financial health are good, but the real strength is in the growth. So it is an interesting possibility. It seems that they have a long runway and can grow a lot in the coming years. But is it the best opportunity out there? Well, if you would like to find some other options for investments, then check out one of those videos. Thank you so much for watching, and see you in the next one.